All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Wednesday, everybody. Today is August 12th, 2026, and our top story this morning is CPI, 3.4% year over year. That's the headline inflation number, down from 3.5% in June. Are you not relieved? Inflation went down. Shouldn't we all be celebrating? No. Oh, no, you don't want to celebrate? Oh, maybe that's got something to do with the fact that this is now 65 consecutive months that inflation has been above the Federal Reserve's arbitrary 2% target. And 2% is a stupid target to begin with. Keep in mind that 2% number, the way they came up with that is because that is the rate of heating up the water where you, the frog, don't realize you're being boiled alive by the cost of living rising. 65 months in a row, we've been above that. Now, let me ask you guys, you ever hear somebody say, oh, how old is your kid? And answer 65 months? No, you don't do that because after, we'll say after 2 years old, you don't talk in months anymore because it's stupid. The kid's now 5 years old. 5.5 freaking years we have been above this 2% inflation target. And they actually, in the middle of that 5 year, they were actually cutting interest rates. And they have already started the money printer up again. They actually did it twice. They did it during the bank failure in 2023. They called it the Bank Term Funding Program, the BTFP. And then they are also doing it now. They're not calling it money printing now, not QE. They're calling it reserve management purchases. All right. The Department of Acronyms is very busy these days coming up with new words for not quantitative easing. They're still printing money. They've done it several times. They were cutting rates. They're still not hiking, even though inflation has obviously risen substantially in the first beginning of this year. And, Kevin Warsh, you talk a big game. You're always out there talking about how we've missed our target for so long and we will deliver price stability for the American people. Man, he says all the right things at meetings, but he doesn't do shit about it, does he? He still hasn't raised rates. 3.4%. Look, it was in line with expectations, down slightly. There's some things we'll look in the chart. There was one thing in particular that kind of jumped out at me as not particularly truthful in the CPI report. I know I'm going to get a lot of the comments. I get this with every CPI, and hey, I'm happy for the engagement about how these are government numbers and they're all manipulated. I'm right there with you. The data is the data. It's all we've got to report. Core inflation, 2.5%, also in line year over year. The month over month numbers did tick up. We had the year over year number went from negative 0.4 in June. That was entirely driven by energy and the memorandum of understanding, which is now bunk. That went from negative 0.4 back up to 0.1. So back in positive territory on a monthly basis. And the core inflation number month over month went to 0.2 from nothing a month ago. So the year over year numbers are still ticking down a little bit, but the monthly numbers going in the wrong direction. So what else we got going on here? Consumer delinquencies, turns out when you miss inflation targets for 65 consecutive months, but who's counting, you end up with consumers that are struggling. And we got some latest delinquency numbers. Credit cards and auto delinquencies, the 90-day delinquency rates in both of those are already well above crisis levels. Autos has already taken out its GFC peak. Remember cash for clunkers? Apparently, auto loans are even worse than they were back then. Mortgages, though, remaining stubbornly low. The delinquencies on mortgages, thanks in no small part to the frozen housing market. However, that frozen housing market is very illiquid and would really struggle to absorb any amount of new supply. And the fact that you've got so many people missing their credit card payments and so many people missing their card payments would suggest some of those people are going to start missing their house payments or their rent payments too. So you got to wonder how long can mortgage delinquencies stay this low? And they have been ticking up very slowly over the last year or so, but certainly not jumping up like we saw in 2008. Student loans, of course, is just an absolute disaster. They absolutely skyrocketed recently thanks to the expiration of COVID stimmies. Meanwhile, we got a lot of earnings this morning as well. CoreWeave shares are absolutely ripping. My favorite company in the whole world. Apparently, revenue doubled at CoreWeave. Well, our revenue doubled. That is great. And the only problem is their losses quadrupled, but that revenue doubled. And apparently, that's a good thing. Apparently, when you double revenue while quadrupling your losses, you are doing good. Am I doing this right? Checking my notes here. Yes. According to the stock, they're doing good by quadrupling their losses. This is the daily reminder, guys, that revenue is not profit. I realize we have this whole new class of investor out there, a bunch of these coked up day trading a-holes who don't know the difference between revenue and profit. But the point of business is to make money, all right? Not to collect $20 while spending $100. That's bad business, okay? You guys with me? Gentlemen, this is a football? Yeah, okay. Back to basics here. CoreWeave revenue doubled to $2.58 billion. But again, their loss is quadrupling. Everybody's making a big deal out of this $104 billion backlog plus $25 billion in backlog that they added in the beginning of this quarter. That doesn't matter because backlog and remaining performance obligations are completely made up statistics that nobody should give a shit about. And the companies that have signed these non-binding commitments in the backlog, none of them have any money. And so they won't be able to deliver on those commitments unless they're able to raise more capital, which is questionable at this point because the bond market is starting to make funny noises every time they try. Hence the $500 billion circular financing that NVIDIA is having to co-sign for that I ranted on yesterday. Deep breaths here. And also CoreWeave. Interesting stat, $35 billion. That's the debt pile at CoreWeave right now. $35 billion and counting, up from $22.7 billion in the prior quarter. So yeah, their revenue doubled to $2.58 billion. All right, we've got like $1.25 billion in new revenue. All we had to do was take out $12.5 billion of new B-rated junk debt in order to achieve that. Oh, and we're paying 11% interest on that junk debt. So CoreWeave's quarterly interest ballooned to $640 million. This business is garbage, and people are buying the stock. But, keep in mind, guys, the point of CoreWeave was never to make money. I know I'm sitting here talking about profit versus revenue, and profit is important. But silly rabbit, remember, the whole point of CoreWeave all along was just to inflate NVIDIA's revenue. It was never about making money. It never will be about making money because it never will make money. Ever. CoreWeave will lose in perpetuity until people come to their senses and they go bankrupt and somebody buys up the assets at pennies on the dollar. It is inevitable. Math is math. Also in the AI earnings sphere this morning, Supermicro reported that stock is up 10% because they reported a bunch of numbers that nobody should care about. I don't care what numbers Supermicro put up. Do you know why? I'll tell you why. Because for the last 2 years, their auditor, BDO, who they had to hire because their last 2 auditors quit, their auditor for 2 consecutive years now has put a rider on their 10K, on their audited financials, that flagged material weaknesses in internal controls over financial reporting. In other words, the company's auditor has said this company is full of shit for 2 years running now. They could report whatever the hell they want to report, and their auditor will sign off on it with that blanket statement protecting them saying material weaknesses. For 2 years, that has been in their 10Ks, and it has been unresolved. And in those 2 years, the co-founder of the company was hauled away in effing handcuffs for violating U.S. export controls, the thing we all know has been going on. Several other employees have been arrested in the same thing. It doesn't matter what Supermicro reports. They are criminals, okay? People, you need to understand, Supermicro is a criminal enterprise. It is in their accounting scandals. It's in their export control violations. So it doesn't matter what they report. If Sam Bankman-Fried were to go on TV and report earnings tomorrow, would anybody care? No, because the guy's a criminal. He's in an orange jumpsuit. All right? It doesn't matter what Sam Bankman-Fried says. He's a crook. Well, Supermicro stock is up 10% because this market will buy anything. Meanwhile, we've got Torsten Slok. This story was great. Torsten Slok is the chief economist over at Apollo. Very big following. When the guy speaks, everybody pays attention. Yeah, he's now saying, you ready for this? Exactly what I've been saying for 3 years. Thank you, Torsten. I appreciate the vindication here. Torsten Slok is saying that basically the entire AI bubble is predicated on the Frontier Labs and their ability to continually raise capital. The second that stops, all the profit margins, all the revenue at the memory makers, at the power plants, at the chip makers, it all goes away. It's all predicated on an endless flow of new investors. Hey, that sounds a lot like a Ponzi scheme, doesn't it? That's interesting. Also, we got to talk about power. I mentioned power there. 1,066 gigawatts. All right. Guys, I realize a lot of you guys don't really speak in terms of gigawatts and things like that. 1 gigawatt is basically the size of a commercial nuclear power plant, right? The average nuclear plant puts out somewhere around 1,000 megawatts or 1 gigawatt. We have somewhere in the mid 90s nuclear reactors in this country. There are 1,066 gigawatts of requested power from data centers currently working their way through the pipeline. All right, so that's about 83% of total U.S. grid capacity. That is the number of requests for power for data centers that have been logged with utilities in the United States. 83% of total grid capacity. It's never going to happen. All right, you don't double the size of your power grid by 2030 because Jensen Huang said a thing on CNBC. All right, I don't care if he's in a leather jacket, or I don't care if it's some skinny Halloween prop looking hedge fund guy who dropped out of Yale wearing a turtleneck. It doesn't matter what these guys say. All right, good intentions and talking points don't pump electrons. 1,066 gigawatts. Go home, you're drunk. It's never going to happen. We would have to build more than 1,000 nuclear plants in the next, 3 years in order to deliver on these promises. That will be very difficult to do. In addition, over the last 30 years, what have we built? 3? But yeah, we'll build 1,066 in the next 3. Okay. Yeah, math gets a vote. Physics gets a vote. 2/3 of these things are never going to get built, according to this analyst and in this article in Bloomberg. And even that, I think, is overly optimistic. I think 95% of this crap is never going to get built. And last but not least, we've got to talk about what's going on in Ukraine again. Guys, wheat prices. This is setting up for next year's food crisis is in the making. Got some weather phenomenon that I've been watching too. But yesterday, several grain terminals at the Russian port of Novorossiysk were hit by Ukrainian drones. The Black Sea Grain Initiative is largely credited. It was this deal that the Turks brokered between the Ukrainians and the Russians to let the grain flow out of the Black Sea shortly after the invasion began. That stopped the blow up in the global food crisis that was happening in 2022. That deal's effectively dead. I mean, it's basically like the MOU between the U.S. and Russia. It's still there technically. It just doesn't mean anything anymore. Wheat price is probably heading higher. Guys, we got a lot to talk about today. Why don't we shrink my big melon of a head? Let's see what's going on in the world of finance. Don't forget the like button and the subscribe button for the algorithm so you can come back tomorrow and have your coffee with us melon heads, because we do this every business day. Right now, the S&P 500 is higher by 42 points, or 0.54% to the upside. Much of that coming in the immediate aftermath of that CPI report. The market is celebrating that for reason. I don't know what that reason is, but the market liked it. We've got the Dow is also higher by 191 points, 0.35% to the upside. The NASDAQ is up 351 points, 1.2% in the green. Market liked the CPI report just because it was in line with expectations. And we've actually got a dollar that's a little bit weaker here. 12 basis points to the downside, 99.70 for the DXY. So the market is saying probably less likelihood of the Fed tightening this morning. All right, we had a weak jobs report last Friday. A weak jobs report would suggest the economy is not overheating, so less of a hurry to hike. And then we get an inflation read that is in line with expectation. That gives us enough room to worry more about the job market, I guess. And so the dollar is a little weaker this morning because of resetting expectations for when the Fed might hike. Meanwhile, we've got the bond market. Yields are heading lower. Also, less aggressive Fed apparently being priced in here. 30-year yield is down 1 point and change at 5.222. The 10-year yield is at 4.653. That's off by 3 points and change. The 2-year yield is at 4.176, down by 4 points and change. And the 1 month is down 1 point at 3.685. All right, so we got lower interest rates and weaker dollar. That's probably good for metals. Put a pin in that. We'll be there in just a second. Looking over at Bitcoin this morning, it is higher by 390 points after having a couple of red days in a row here. $63,910 for Bitcoin this morning. Still in this range we've been in for about 2 months here. All right, looking over at the commodities board. Yup, metals are doing pretty good this morning. Spot gold, $4,419, back above 4,400. That's higher by 51 bucks this morning, or 1.16% in the green. Spot silver is looking good as well, $65.85, higher by $1.12 or 1.75%. We went as high as 66.79 today. I like the shiny. Let's look at those charts in just a tick, shall we? But first, copper is higher by 0.29%. Platinum also looking good, up 1.86%. Palladium just behind it at 1.38% higher. And crude oil is down by about 17 cents, $83.05 for September WTI futures. Not a lot happening in oil markets today. Look at this gold chart. That is a very pretty breakout we got in that oil chart. Looking at daily candles here. Happened back in the beginning of August, shortly after the second round of yen-tervention. We saw gold start to rip here, and well, it's been up and to the right ever since. I'm not ready to scream we're back to last year's gold rally. It would be nice. I'd like to see it maybe happen a little bit or a lot a bit slower than it happened last year. I don't like the whole FOMO thing. But it certainly looks like we have broken out of this wicked downtrend that started in January. Silver doesn't look quite as good, but silver does look pretty good. Again, looks like a breakout here, 65.88. Actually, it looks like a breakout with a little bit of a retest going on here as well. So I'm liking the look of the silver chart. Doesn't look quite as nice as the gold chart does. But both of these are looking all right here this morning. All right, let's talk about inflation. The annual inflation rate in the U.S. slowed for a second consecutive month to 3.4% in July, down from 3.5% in June, and in line with expectations. You can see in the chart here, we were 4.2%. That was the peak in May when oil prices hit their top. Then we had the deal, no deal that we've been in for the last 3 months. Now we are down to 3.4% for the month of July. And again, that 65 month, I got to give that credit to Charlie Bilello from Creative Planning, who says 65 consecutive months with U.S. inflation above the Fed's 2% target. The Fed has lost all credibility when it comes to fighting inflation. And Charlie, thank you for posting this, by the way. This was a good point here. Remember the next time we're watching the CNBC guys and the Bloomberg guys and all these people in the Fed press pool, when they're asking questions during the next Fed meeting and they say, are you worried about the Federal Reserve's credibility? Or what do you say to people who say the Fed risks losing credibility? Why are we even asking this question? If you missed your targets at your job, if you're expected to deliver so many units a month, or if you're expected to make so much money a month, for 65 months in a row, you missed your target, would you still have a job? Probably not. Your company would probably be out of business, depending on what your job is. The Fed has missed it for 65 months in a row. Why are we even talking about Fed credibility? They don't have any. Jesus, guys. And again, at this point, after this, right, after what we went through in 2022, any of this is unpalatable because people already can't afford what happened to them 3 or 4 years ago. So any inflation today is unaffordable and just adds to the cumulative effect of this. And of course, people's wages haven't anywhere near kept up with this. And we'll see in just a few minutes here what the net effect of that is on some of these consumer numbers. First, let's look at some of the monthly ones. The month-over-month rate for the headline inflation, back in positive territory, 0.1 after that big negative print that we had last month. That was driven entirely by energy and the memorandum of understanding. Core inflation, which strips out volatile food inflation, food and energy, hit 2.5% year over year. That is down from 2.6 in June and way down from the 2.9 that we had in May. So core inflation is trending lower. That is encouraging, at least. It's still too high. But the fact that core is a little bit more resistant to the fluctuations because of the Iran war, but even still way too high. And on a month over month, we're back to 0.2% after hitting nothing in June for core inflation. Let's look at the chart and where the inflation actually is. What we're looking at here is your annual number for these various categories in this column. And then you've got your monthly numbers for July, June, and May shown in these other categories. So there's your headline number at 3.4% year over year and 0.1 month over month. Food at home, or the food index, went up by 3%. Food's getting more expensive. Apparently, food at home got a little bit cheaper in July, down 0.1% for the month, but still positive year over year by 2.7%. I remember seeing that and saying that's probably going to upset some people because I seriously doubt anybody noticed their grocery bill going down last month. Seriously doubt that, if at all. Food away from home continues to get more expensive. Restaurant prices are unaffordable, 0.3% month over month, 3.4% for the year. The energy index, this is interesting. The energy index still 14.7% for the year, but negative for the month again. And I got to say, there's some of that energy stuff doesn't quite pass the sniff test, right? Back in March, we had the big jump when the war broke out. And then we had some pretty high prints in April and May on top of that in the month over month. We had that big negative print in June because of the memorandum of understanding, but apparently energy went down again. And within that category, this number in particular jumped out at me. According to this CPI math, again, guys, not my numbers. The data is the data, all right? I can only look at the chart and tell you what it says and then give my opinion on it. It's not my number. 2.9% lower for gasoline for the month of July. And I saw that, and I'll be honest with you, that just did not pass the sniff test with me. Gasoline prices went up in July. All right, they definitely, this number back in June, I could believe that we had that 9.7% decline. We all saw gasoline prices go down in June, but they should have gone down a little bit more than they did, didn't they? Right? I mean, the prices seem to go up a hell of a lot faster than they come down always. Isn't it funny? But they're telling us they went down in July. No, they didn't. Gas got more expensive in July. At least for me, it did. I don't know about you guys. The year-over-year number is still 24.6%. But I'm really struggling with that one, to be honest with you. Also, fuel oil supposedly went down. I'll be honest with you, the guys, that's really the only number that really stuck out at me. New vehicles up 0.1% for the month, 0.5% for the year. Used cars and trucks, 0.4% higher, but slightly negative year over year. And then what else we got? The shelter index. This is kind of interesting as well, the shelter index. We've been at 0.1% for the last 2 consecutive months. That is the lowest I've seen since I started this channel. 2 consecutive months of 0.1% monthly increases in shelter. Shelter is the biggest component of the CPI. It's more than a quarter of the weight in the index. At 3.2%, almost 2/3 of the increase in CPI was due to the increase in the price of shelter here. And on a monthly basis, at least, the price of shelter is starting to slow. So the good news is if we see several more months like that, we will start to see the annual CPI rate come down. The bad news is the reason why shelter is getting cheaper, it's not because new supply is coming to market. It's because people can't afford shelter. That's not necessarily a good thing. Also, and you can kind of see it in this chart here. Why would the shelter number be coming down? I don't know. Maybe that's because credit cards, 12.9% of credit card balances are now 90 days delinquent or more. That's almost the same level we saw at the peak of the GFC in 2011. Yikes. 12.9% of credit card balances are 3 months delinquent. And again, when you're 90 days delinquent, you're on the brink of bankruptcy at that point, right? You're probably not going to be paying that bill if you've missed payments for 3 months. That's not even making the minimum payments. Also, you'll notice on here, the red line, that's your student loan debt. That has rocketed higher as pandemic forbearance programs and moratoriums on student loan payments have rolled off. We are seeing that level rise again. Maybe not quite crisis levels, but I think this is going to keep climbing. And I think we probably still have a couple of states that are underreporting their student loan delinquencies because of political reasons. And also auto loans, the green line here, 5.49% of auto loan balances are 90 days delinquent. That is higher than the peak we saw during the GFC. All right, so credit card and auto loans, the delinquency rates, 90-day delinquency rates. And again, if you're 3 months past due, you're in big trouble on your credit report. For credit cards and auto loans, it is as bad or worse than it has ever been. And the only reason people aren't screaming about this from every rooftop is because mortgages are still low. Just a little less than 1% of mortgages are 90 days delinquent. But the problem is we've got a very illiquid market that can't really absorb any new supply. And, these things, auto loans, credit cards, if you're going to miss a payment, you're going to miss the credit card or the car payment before you're going to miss the mortgage payment. Because the mortgage payment, people are just more likely to pay for the house first. These would front run what you would expect to see the mortgage payments do. So again, we're not in a subprime mortgage crisis, certainly by any measure. These numbers have been trending up a little bit. But again, you've got all these COVID era programs are starting to roll off at the FHA. My friend Melody Wright has done an excellent job covering those. Those are starting to translate into more delinquencies and into more foreclosures in the pipeline. So that number is going to keep trending higher. But this is the result of 65 consecutive months of missing inflation targets. All right. Meanwhile, CoreWeave shares soar after booming AI demand boosts outlook. Yes, forget the fact that their losses quadrupled. Forget the fact that their debt pile has increased by 50% in just 3 months. No, demand is booming. And of course, don't forget your pom-poms along the way, Bloomberg. CoreWeave, a provider of compute that powers AI systems, surged in pre-market trading after the AI spending frenzy spurred faster sales growth than anticipated. Sales will be $3.45 billion to $3.6 billion in the third quarter, the company said. Analysts had estimated a figure at the lower end of that range, according to data compiled by Bloomberg. The firm also said its backlog, a closely watched measure of future sales that nobody should closely watch, was $104 billion at the end of the quarter. And CoreWeave inked more than $25 billion in new customer commitments after that period ended. And again, guys, this doesn't matter. This is just future payments that may or may not ever be there because these are non-binding commitments. It's not like these are take or pay contracts. And these are from companies that don't have the money to pay it. So if those companies are unable to issue new bonds or issue new equity for whatever reason, they won't be able to pay this $104 billion plus 25 to CoreWeave. It's a completely made up statistic. Oracle does this too. And it just it's deceptive. And the fact that they're reporting this and not how much money the company lost is really striking. The growing backlog suggests AI demand remains strong, said somebody at Bloomberg. CoreWeave has become a bellwether for the AI data center boom. Wall Street firms pouring hundreds of billions of dollars into the build-out of digital infrastructure are closely watching its performance. It's one of the few AI computing suppliers known as neoclouds that are publicly traded. For the full year, CoreWeave raised its revenue outlook to a range of $12.4 billion to $13.2. Previously, the company had anticipated $12 to $13 billion. Revenue more than doubled to $2.58 billion in the second quarter. The company said its net loss, meanwhile, was $1.14 a share, narrower than projected. Look at how Bloomberg minimizes the loss. Oh my God, revenue more than doubled. Losses were less than projected. Less than projected, but they still quadrupled, dude. I mean, extrapolate that. If we keep doubling revenue and quadrupling losses, 20 years from now, things are just going to be awesome, right? Analysts had estimated sales of $2.56 billion and a loss of $1.41 a share. My friend Dario, just Dario on Twitter, he posted this one. Do CoreWeave investors even read the numbers of the company they own, Dario? Come on, buddy. Come on. You never ask a question you already know the answer to, Dario. Of course they don't read the numbers for the company they own. That is the few of the CoreWeave investors that actually can read. They choose not to. But had they both the capacity and willingness to read, they would, of course, realize what Dario has pointed out here. The fact that, okay, yeah, look at this revenue number, $2.575 billion. The revenue versus the same quarter a year ago, 1.212. Wow, it more than doubled. That is so great. But then look at the adjusted net loss. It was $130 million a year ago when they weren't profitable. They're still not profitable. Now the adjusted net loss is $567 million. More than quadrupled, up 4.5 times. All right, we lose money on every transaction, but we make up for it in volume. That is what CoreWeave told us yesterday, and these idiots bought the stock on that news. All right, guys. By the way, the whole debt thing, that's a problem because CoreWeave is junk rated. They've got their B rated debt and they pay 11% interest, and that's really expensive, especially when your debt pile is growing even faster than your revenues and your losses are. CoreWeave's debt hits $35 billion. What it means for NeoCloud financing wall. By the way, the NeoCloud financing wall, that's the first time I've heard that phrase, but that's interesting. This one in capacityglobal.com. CoreWeave, the largest publicly traded NeoCloud, reported total debt of $35 billion as of June 30th. That's up from $22.7 billion in long-term debt at the end of the first quarter. Their debt went up by $12.3 billion in one quarter. 50% Q over Q increase in debt, and everybody's leading with the revenue hitting $2.5 billion when they had to take out $12.5 billion of new debt to get there. Come on, guys. Math gets a vote. Net interest expense reached $640 million for the quarter, more than double the $267 million recorded a year earlier. Oh, the revenue doubled. Yup, so did your interest payments. As a matter of fact, the interest payments are getting big pretty fast here. The company financed $9.4 billion in quarterly CapEx. Revenue backlog grew to $104 billion. But look at this. The company forecasts $35 to $39 billion in annual CapEx for 2026. So they're going to keep growing that debt pile by, it looks like, close to $10 billion a quarter. And they're already paying $640 million a quarter just in interest. And again, we got to talk about that debt is now maturing inside a tightening window between 2026 and 2028, a pattern some industry commentators have termed the NeoCloud refinancing wall. And do you think they'll be able to refinance that debt at a lower interest rate when their losses are quadrupling? Probably not. Interest rates only seem to be going higher in my book. But you know what? Apparently, this is what passes for good results, because look at CoreWeave stock. It is ripping 19.5%. I got nothing here, guys. I got nothing. Maybe there was something else hiding in the earnings that was really good. I can't find it. Whatever it was, $108 a share for CoreWeave. All right, have fun with that one. All right, meanwhile, Supermicro stock surges as earnings smash expectations and revive AI hope. Oh, the hope, the expectations, so good. Supermicro computer stock was surging in Wednesday's pre-market after the server maker's fiscal fourth quarter earnings smashed Wall Street estimates on accelerating artificial intelligence demand. Supermicro reported adjusted earnings of $1.70 per share on revenue of $11.1 billion after the bell Tuesday. Analysts surveyed by FactSet were expecting just 92 cents per share on revenue of $11.6 billion. Oh, that actually looks like a revenue miss, but I digress. In the same period last year, Supermicro reported earnings of 41 cents a share and revenue of $5.8 billion. Oh, Charles Lang, we report many too big number. Yes, congratulations, Charles Lang. But here's the thing. Here's the thing with this company. Nobody should care at all what they report. When you have a line in your 10K and your auditor flags material weaknesses in internal controls over financial reporting, that is your auditor calling you a liar. All right. And when liars say things, you should not care what they say because they are liars. Are you still with me? Gentlemen, this is a football. It doesn't matter what Supermicro reports. These are unaudited financials. And every time their auditor takes a look, they say these guys are full of shit. Oh, and since the last time the auditor said these guys are full of shit, their co-founder, Wally Law, was carried off in handcuffs for violating Chinese export controls. You can't make this up. That's the same Wally Law who was fired in 2020, 2 accounting scandals ago. And then as soon as the company got relisted on the NASDAQ after that accounting scandal, they hired Wally Law back. And then a few years later, he gets arrested for export controls. Supermicro is a criminal enterprise. Is not a stretch of the imagination to say that. So you should not care what this company reports. Oh, they reported many too big number. Good. Number go up. This stock is a zero long term. Charles Lang will end up in jail someday. Mark my words. For now, Supermicro Computer up 16.9%, 36.92. Are they higher? No, they're not. They're still not back to when Wally Law got carted off in handcuffs. But they're having a good morning here, up $5.35. Companies that lose money, companies with accounting scandals, material weaknesses, co-founders in jail, and people just can't get enough of the stocks. Guys, what is happening? What is going on here? I feel like I'm taking crazy pills. Thank you, though, Torsten Slok. All right. Finally, somebody saying it. Torsten Slok, the chief economist at Apollo. This was a pretty good blog post that he wrote. He says, in business, profit margins are frequently higher for the owner of the end customer relationship. But that is not the case for AI. In AI, profit margins are higher the further you get from the end user. And he references the chart below. This is important because it means the AI boom's profits are currently being funded by investors rather than earned from customers. The upstream margins are real, but they are paid out of capital raised by the layer losing money, not out of cash generated by demand. It is amazing how many of these AI bro imbeciles cannot understand this concept. There are no profits in AI. None of them make money. All right, I'm going to read it again. The upstream margins are real. The people selling the hardware, yep, they're making money, but they're paid out of capital raised by a layer of losing money, not out of cash generated by end demand. This makes the 41% profit margins for the hardware manufacturers contingent on the negative 59% margins continuing to be financeable at the frontier labs. The bottom line is that the most profitable part of the AI value chain depends on the least profitable part continuing to grow revenue or raise capital. And by the way, Torsten, you're wrong. It doesn't depend on them continuing to grow revenue. Revenue is irrelevant. It is dependent on them ever making a profit. And none of them are getting closer to making profits. They're getting further from making profits or raising capital. In other words, Ponzi scheme, get more investors to pay out the old investors. Capital can bridge the gap for a while. It's already been 4 years. How long does it have to bridge that gap? It's a very long bridge, but not indefinitely. And therein lies the risk. Will the ROI show up for AI's end customers fast enough to sustain the spending that is generating those upstream margins? Guys, why are we even asking this with a question mark, Torsten? I get it. You've got this big reputation and you don't really want to say anything until you're like, it's so painfully obvious that you know you're safe in saying it because you don't want to risk your reputation. But no, there is no ROI in AI. We're in year 4 of this ridiculous exercise, and we're still asking the question, will the ROI show up? You know, like, I mean, it's like it's 11 p.m. and you're still sitting at the restaurant by yourself, and the waiter just came over for the 6th time asking, sir, would you like to order? She's not coming, dude. I don't know I don't know what to tell you. But here's the chart right here. And again, here's the frontier labs, right? The closer you get to the customers, negative 59% profit margins. All right. Yeah, the demand is insane. When you're giving away $50 or when you're giving away $100 bills for $50, the demand is going to be insane. You're going to have a lot of customers. All right. The problem is eventually you're going to run out of $100 bills and somebody's got to give you more $100 bills because you're only making 50 back. Gentlemen, this is a football. Yeah, negative 59% profit margins for AI. And then the further away you get, the worse the profit margins get. It's only the hardware guys that are making the money. And again, guys, these are operating margins. Operating margins don't even include the freaking, is it depreciation or interest? One of those doesn't. I'm not an accounting major. But for the hardware guys, those are huge numbers that are not even being counted in those. And that's why the compute and cloud guys, they lose money too. Energy and grid company, okay, they're making money, the energy and grid, but we're going to see in a minute how that demand is never going to be met. And then, of course, the silicon and equipment, that's when you get that ridiculous move in South Korean stocks and NVIDIA going up infinity percent because all of this profit is being financed by all of these losses. Eventually, people are going to notice these losses. Eventually, it ain't today, that's for sure, as evidenced by CoreWeave and Supermicro stock, but eventually it's going to matter. Now let's talk about power, because this is a big one. Most power sought for U.S. data centers will never materialize. In other words, those data centers will never materialize. But you know what? It's not stopping them from selling the GPUs that are never going to get turned on. That's for sure. More than 2/3 of the electricity sought for the artificial intelligence boom in the U.S. isn't likely to materialize due to phantom projects and long shot pitches. That's based on new projections from Wood Mackenzie, which is an energy consulting firm. which sees U.S. grid operators and utilities likely committing to only about 28% of the 1,066 gigawatts requested for data center projects. A gigawatt is the equivalent capacity of a traditional nuclear reactor. While no one expects every proposed project to be built, the data reveals how inflated projections of future power demand complicate planning and budgeting by utilities and grid operators. That can translate into higher utility bills since capital costs for upgrading infrastructure are typically covered through rate hikes. 1,066 gigawatts of new demand. Shut up. Go home. You're drunk. Everyone's trying to figure out the rules of the road in order to make this the most efficient process without increasing grid prices, said Alex Klessig, co-founder of energy market intelligence firm Halcyon. They're saying here more than 2/3 of this will likely never materialize here. 763 of that 1,066 gigawatts is uncommitted and unconfirmed, imaginary projects that will never get built. Are these projects, by the way, are these included in any of these remaining performance obligations or any of the revenue numbers that are being reported by the hardware manufacturers? Or any of this giant slice of like Pac-Man with his mouth open that's never going to happen? Is that responsible for the blow up in memory prices? Jeez. And you scroll down here, of course, the 1,066 gigawatts of applications cited by Wood Mackenzie would require a staggering jump in U.S. electric capacity. That amount represents 83% of the nation's total utility scale generation capacity at the end of last year, according to the Energy Information Administration. All right, so all we got to do is like double the U.S. power grid in the next 3 years in order to accommodate all the stuff these tech bros have promised us. I think that's a reasonable thing to expect, right? Oh, no, it's not? Oh, okay. Many applications are from firms with no prior experience building facilities with energy needs that can rival mid-sized cities. How hard can it be? How hard can it be to build an industrial facility that uses the power of New York City? Really hard, apparently. The projects of those first-time developers are often disproportionately large. Oh, you mean they promise more than they could ever hope to deliver? That's weird. Though generally less likely to come to fruition than those of well-established big tech firms, said Wood Mackenzie analyst Caitlin Connolly. In other words, guys, it is all hot air. There's no power. They're not going to build the power. And the people who are responsible for delivering that power are not taking them seriously, and neither should you. All right, last one of the day. 2 grain terminals at Russia's Novorossiysk halt work after Ukrainian attacks, sources say. 2 of Russia's biggest grain terminals at the southern port of Novorossiysk have suspended operations at the result of overnight Ukrainian drone strikes. 4 industry sources told Reuters on Wednesday. Russia is the world's largest wheat exporter, and most of those exports are shipped via its Black Sea ports like Novorossiysk. I'm sure I'm saying that wrong. Russia's main grain lobby group warned last month that Ukrainian drone attacks could shut down grain exports via the Black Sea in the near future, pushing up prices and causing hunger in Africa and the Middle East. All right, so we've been talking a lot. This port of Novorossiysk, it's been hit a lot. They shut it down for loading oil recently with the Caspian Sea pipeline that brings oil over from, I think, Kazakhstan is where it connects to. That has been shut down. The Ukrainian drone attacks in the Black Sea and the Sea of Azov have been devastatingly effective. The Russians have been retaliating with ballistic missile attacks, in particular on the Ukrainian port of Odessa, where more than a third of Ukrainian grain shipments have been shut down by those Russian counterattacks. Now the Ukrainians are targeting Russian grain exports in Novorossiysk. What does this mean? This means higher wheat prices, guys. Look at the chart of wheat prices. This is going all the way back to 2022. And just as soon as my chart wakes up, I said just as soon as my chart wakes up. There we go. Thank you very much, TradingView. Look at what wheat prices did in 2022. You guys remember that one? That was immediately following the invasion, and everybody was worried that Black Sea grain exports were going to get disrupted. And then, right around here, Turkey negotiated a deal between the Ukrainians and the Russians where they kind of had like this like gentleman's agreement, like the wars of old, where, okay, we're going to kill each other, but we're not going to shoot at the food. That was the agreement they cut in 2022. And that, along with the dumping of the Strategic Petroleum Reserve, brought down fertilizer prices and brought down wheat prices. Now that's gone. All right. The Black Sea initiative that the Turks brokered between the Russians and the Ukrainians, it's still there. I mean, it's still a piece of paper with signatures on it. It's just nobody's doing what they said they were going to do on that piece of paper, kind of like the memorandum of understanding between the U.S. and Iran. Oh, it's still a thing. It's just nobody cares. Guys, grain prices probably going higher here. And I tell you, we got this El Nino thing developing in the Pacific. That is next year's weather getting awfully dry in a lot of parts of the world where they grow a lot of food. Now, there's a lot could happen between now and then. Maybe that weather pattern changes. But food prices next year are shaping up to be a hell of a lot higher than they currently are. And this certainly isn't going to help. Hey, I just want to say thank you, everybody, for having your coffee with us Melonheads this morning. Don't forget the like button and the subscribe button for the algorithm, all that good stuff. Thank you also to my magnanimous Melonhead members on YouTube, Patreon, and Buy Me a Coffee for supporting the channel. You guys rock. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.